Good morning, everyone. Today, I will continue with the chapter Financial Literacy and Financial Planning. Let's start with basic money management. What do you mean by money management? Money management means what? Money management means how do you manage your money? How do you manage your expenses? It means managing your spendings and making a budget. The goal of a money management is prudent financial control. Now, basically, money management is how do you manage your money? How do you manage your expenses, your income, and then after all your expenses are expended, then how you do your savings for your financial future? It all depends on money management. Have you ever kept a track of your financial spending? If you keep a track on your financial spending, it enables you to identify trends in your financial actions. It means that every month or every 15 days, what are you spending on? How much are you spending? Are you saving anything after once you get your salary or your income? Are you saving anything? So this is what money management. But now, before you do any money management, first of all, you should know how to create a budget. Once you create a budget, then you will know how you can manage your money. Can anyone tell me how to create a budget? See, to create a budget is very simple. First of all, you should know what are your incomes. All your incomes from here, from there, from all over wherever you earn income, you enumerate means you collect all your income sources, which includes your part-time work, your allowances, and your salary. Then after that, you include both your variable and fixed expenses. Means like your fixed expenses like groceries, you can say your electricity bills, everything, all type of bills you pay monthly. Then your variable expenses means you go for shopping, for social life and everything. After that, you include, after including both your fixed expenses, then you make a note of this. Figure out how much money is left over by deducting all your expenses. After you know what your income is, then you deduct all your expenses. After that, after deducting all your expenses from your income, you can spend this money on enjoyable activity. Like whatever income is left, you can enjoy this through the leftover money. This is what is called as discretionary income. What it is called as discretionary income. So I can give an example if you want. See, suppose you have 500 rupees as your income. Suppose you have your 500 as a monthly income. Out of 500, you are paying 300 for your fixed costs. Fixed cost means you can say your rent, your bills, your basic expenses, everything. After that, then only after from 500, 300 is spent, leftover is 200. So what you can do with this 200 leftover? You can put this for savings or towards your other financial objectives. Basically, this is to your building your money management, your savings for your future. Another important part of money management is what? Another part of your money management is prudent debt. Is your prudent debt? What is prudent debt? Means all your debt which you have incurred. All your debt which you have incurred, like normally when you incur any personal loans, when you have taken any loans, so you have to pay interest on it. So first of all, you have to prioritize your interest, like credit card debt. If you have any loan bills pay, like credit card bills, you have personal loans, you have any taken any student loans. Prioritize first pay of your high interest debts, because paying your interest debt is much more having good advantage on your building a wealth. As soon as you clear your picture over time, using this strategy, you can save your money. Once you start doing if you have any debt and if you prioritize your payment of debt firstly, then you can start having your increasing your financial management. 1 minute. Now I'll explain you what is cash flow. What do you mean by cash flow? Cash flow means movement of money. Cash flow means movement of money into and out, of your account is referred to as cash flow. Means what? At the end of the month, see, if you're working in a job or in a business, at the end of the month you get salary, so that is what your inflow. And during the month you make expenses, you spend, what is that? Outflow from your account. So this is what movement of money in and out of your account is referred to as cash flow. Always keep your cash flow positive, which is very crucial in your financial objective. What happens when your income is less than expenses? You will incur hardships, financial hardships, which results in debt accumulation, etc. Always keep an eye on your cash flow. You have to always check that you're not going negative in cash flow. You should always try to remain in positive cash flow, because if you try to remain positive, then you can if you try to keep your money cash flow positive, then you can go for financial objectives, financial planning. But once you have your negative cash flow, then you cannot, then you will face a lot of hardships. So this is what you mean by cash flow. Let's go ahead. Now I can tell you what are the key activities of a budget. Normally keep a spending diary. Then you write down everything you want to buy, no matter how small it is. Then you have to review your spending habits and discuss your findings with someone you trust. You can even check that, are these any of the areas you're spending? Can you cut these? So that you can reduce your spending? So then this is how your financial objectives, financial management, money management will grow. Now we learn about savings and investment. Savings and investment today's world is very much important, because in today, as it is uncertain about your life, about your goals and the world, you have to have financial savings and investments. Goal setting in terms of finance requires saving money. It is for safety. Safety for what? Unforeseen cost, like unplanned auto repairs or payment of bills. Means any emergency. Basically, why do you do saving? To meet an emergency expense, to meet an unforeseen cost, which is unplanned. So you should have some savings in your hand. And once you start saving, then you should start investing too. So saving and investment is very much important in your financial plan. Why saving is important? Can anyone tell me that? Saving is very much important. You can better prepare your future by savings. It enables to seize your opportunities, like making business investments or home purchases. Once you start saving, when your savings increases at certain point of time, you can start doing a business investments, or you can purchase any property. And through this and more time to grow, you start saving early. Once you start saving early, your money starts growing. There's some long-term and short-term objectives you can find with savings. See, long-term objective might be retiring or purchasing a home. Like long-term objective means the next 10, 20 years, what do you want to do? You will save now for your future retirement, or if you are planning to buy a house. Then what is a short term? Short term objective means you want to go on a trip or getting a new technology. Means short term means you want to go on a trip or you want to buy anything for your social life, whatever. Then there are different types of savings account. Now how can you save? You can save in there are various saving methods. Like you can have saving accounts. There are various saving accounts. There are various savings accounts of into taken into account. Like you can say is each access to funds is provided by regular savings account. Now, if you want to save, where will you save? You will save in savings account in a bank, although they might have some limitation. Okay, in return, higher rate of interest. See, savings accounts normally have rate of interest which you earn interest on that. Then you have certificate of deposits, which locks your money for predetermined period. Then you have is see all the different types of people prefer different types of savings. One prefer like I want to for some period I want to lock my money funds in for some period of time, say 1 year, 2 years. Some say I want to lock it for 5 years, 10 years. It all depends person to person. You in return for if you want a higher interest, what do? You lock it in certificate of deposit, lock your money for a predetermined amount of time, like a huge amount of money for 5 years, say 5 years or 10 years. You can select that option whenever that's choose your motive. Then how will you start invest? You have saved now. Savings are done. Now after savings, what will you do? You will start investing. You will start your investments. How will you start your investments? You can increase your money by over time by investing. How? It like you can invest in stocks, bonds, or mutual funds. You can even invest for long-term growth or for short-term objectives. It all depends on you. So investing nowadays is very much important. Then you have a risk and reward. Although investing initials risk, they are often large potential risk. Means what? See, you start investing, there's always a risk whenever you invest. Lower the risk, lower the reward. Higher the risk, higher the reward. Because once you invest, you know the risk is high. I might lose money, or if I don't lose, I will earn a good amount of interest. So if there's higher risk of losing money, there is also a higher risk, higher reward, earning reward. And if there's lower risk, then you will earn lower reward. So this all depends upon the individual or the investors. Stocks, see, despite the potential high for high return, stocks can be quite volatile. Conversely, bonds typically yield smaller returns but are safe. Okay. Credit. What do you mean by credit? Understanding credit. The ability to obtain money or obtain goods and services with the commitment to make payments is what known as credit. What is credit? Credit means to borrow money or you obtain any goods or services with a commitment. You make any commitment for making payment later is known as credit. Means that suppose today you purchase goods and then you say to the shopkeeper that I will make the payment after 1 month, say 2 months or 3 months. So you're making the payment later, which is what do you mean by that? You're purchasing goods on credit. This means what? You're not making the payment immediately, but you're making the payment after some period of time. So this is known as you're purchasing on credit. Making educated financial decision requires a solid understanding of credit. Nowadays, when you start making any financial decisions, for that you should have a good knowledge of credit. You should have solid understanding, means you should know what is credit, why is credit important in decision making, will credit have an adverse effect or not. Credit also plays a very much important role in your financial decision making. You can also you can make purchases with credit and not have to pay for them right now. Again, same thing which I just explained is that only. Maintaining financial stability requires an understanding of how credit operates. Exactly. If you want to know what to have a good understanding of financial credit, you should have to have a financial stability, which requires a understanding of how credit operates. Now, the different types of credit. Credit involves there are different types of credit. Like you can say you you have mortgages. You have similar to mortgages and auto loans, installment loans, which you require to borrow a certain amount and pay it back gradually. You don't pay it back immediately. You pay it back gradually. So these are what you can use credit wisely if you're aware of these types. Means like suppose if you want a loan, you have taken the loan and now you have to pay back the loan. You can't pay it immediately. You have to pay in installments. So this is what you're paying the amount gradually on credit. Now, why a credit score? Now, what do you mean by credit score? Credit score means what? Like whenever you take anything on credit, you make any purchases or any receipt on credit. What do you mean by credit score? Means that they allot whenever you take any goods on credit, they allot you a score. When they allot you a score, it means that how good are you in taking credit? Do you make payments on time? Suppose if you say I'll make the payment after 2 months, do you make the payment after 2 months, or you delay even after 2 months? So this all depending upon your payments and your transaction, a score is assigned to you. So higher the score, the better creditability you are, and the lower the score, the lower creditability you are. A numerical representation of creditworthiness is a credit score. It is used by lenders to assess a risk as borrowers. Obtaining a loan with a lower interest rate is more likely than a higher score. So again, you should know what you mean by a credit score. And having a good credit score is very much important for your financial decisions, your portfolio, and everything. Because this all gives you how good are you, how wealthy investor you are making your payments and receipts. Now, how do you monitor your credit? Monitoring your credit is very much crucial. It's very much important. You can obtain a free. You get a free credit report and from these agencies. You can obtain these report from these agencies and know what is your credit score. What details I look for my report in your opinion. So you have to go to reporting agencies and ask for a credit score. The next you have is financial products and services. Financial products and services means what are these? These are instruments to assist with money management. These are what? These are instruments which help you to assess your money, where you can keep your money. To make well-informed decisions, it is essential to recognize these options. Means that if you want to have a good decisions, if you have to make a well-informed decisions, financial decisions, what do you have to do? You should know what type of options are there. You have to recognize these options, and accordingly, which suits you, you should opt for that. Then, what are financial products? Financial products are what? Financial products are the lending, insurance, investments, options, and savings accounts are examples of financial products. What are financial products? You lend money, you take insurance, you have an investment options, you save in a savings account. They're all examples of financial products. Products are what? Financials. Recognizing the functions of each product is essential. If you know what type of functions each and every product provides, you should know that, and that only helps you in making financial decisions. For example, see investing. can help you in accumulating wealth over time, but savings are great for short-term service. If your goal is short-term, then you can opt for savings account. But if your goal is for long-term, then you can go for investing. Then selecting the right service. You have to select the right service at the right time and the right place. Means that when you're making the right financial services, selection can help you to save money. Means suppose if you want to make financial decisions in stocks, you have to decide which company share should I purchase, which is good for me, which is good, which gives higher returns, which gives good dividends, etc. And is it for, can I purchase this for long term or short term? Is it beneficial for me? So it all depends upon the selections you make, which type of decisions, investment products you have to choose. Then you have is comprehending fees and cost. Many products have fees like accounting. Like now, suppose you make investment decisions, it is always all chargeable. It is never free. They charge you some cost. Like many products have fees like account maintenance. Whenever you open a savings account, what do they do? What do the banks do? They charge you maintenance fees. Or if you make any transaction after up to a certain limit, then they charge you transaction fees. Understanding this cause is essential to prevent surprise. It means that suddenly when you make a good amount of transactions during the month or during the year, they charge you high maintenance fees or high transaction fees to prevent sudden surprises that how come there's so much of charges are there. You should know these charges, fees and everything. And accordingly, you should do your transactions. Now, the examples of financial, I have exactly told you what are the examples of financial products. These are all your financial products. You should know these very well. Now, basis of tax. Can you tell me what do you mean by taxes? Taxes again is one of the most important element in your for having a financial planning. To have an effective financial planning, you should have taxes. You should understand what is taxes. Taxes fund public services, infrastructure, and government programs. Taxes are fund public infrastructures, government program, etc. What are exactly taxes? Taxes is what they're payments. You can say they're statutory payments or mandatory payments to the governments. Every individual who earn income, like you have income tax, you have direct tax, you have indirect tax, you have to pay TDS, you have to pay GST, whatever transactions you do any services you incur, then you have to pay these tax on these receipts or payments you make. There exist different types of taxes, like you have income tax, you have sales tax, you have property tax, etc. You should know what type of taxes are you paying, when are you paying, how much are you paying, and are you avoiding that payment? And if you avoid, you have delays, you get if you don't pay on the due date, you get penalties charged, etc. So this also plays a very much important role in our decision making, financial decision making. Then you can say the types of taxes you should know. There are again primary categories of tax you have a what? You have sales tax, which is applied to purchase, whereas income tax is based on your earnings. You have sales tax, which is applied on purchases, whereas you have income tax, which is based on earnings. Then you have real estate tax. The real estate is subject to property tax. Real estate is subject to property tax. Then you have is the lower your tax liability with the help of tax planning. Means that you can lower your tax, means that if you have a better understanding of financial planning, your where you can put your investor money, accordingly you can save your tax. Where you can lower your tax liability with the help of tax planning. You have to have a good tax planning so that you can pay less tax to the government. Okay, this is what, and this taxes also plays a very much important role. Then you have investing in your future. Means what? What is investing in future? Investing in your future is one of the best financial decisions you know till now. It is a very much best financial decisions you have made. It allows your money to grow over time, and you haven't started till now. Please start, and it becomes a successful strategy. Why do you have to now? I can tell you why you have to make early investments. Why you have to make early investments as like when you reach in your 20s or late 20s or starting of the 30s. Investing earlier gives you money, more time to grow. See, when you start investing as early as possible, it gives you time. It gives time, it gives time for money to grow. And as it grows, your wealth increases. Compounding interest allows even small investments to yield a significant returns over time. Like when you start investing in savings or you can say mutual funds, they need time to grow. As time goes, your interest compound. Your interest is being earned. Interest on interest is being earned. So this is what it allows money, even small investments yields to give you a higher significant return. Investments can be used to pay for a home purchase or to finance your education. Investments, then it helps you to make any future payments. It helps you to purchase houses, or it helps to pay your expenses and everything. Then investment types. Among other things, investment can also help you to make in it helps you to make in mutual funds. Again, I told you earlier, stocks and bonds. Then stocks signifies ownership in a company, while bonds are loans to the governments or corporations. Mutual funds buy a variety of assets by pooling the capital of multiple investors. Mutual funds, what do? They buy a variety of assets. Means they don't buy one type of asset, they buy a variety of assets and then they pool in one, you can say in one box, and then they purchase accordingly. And knowing more option will help you to make more informed decisions. This is what the different types of investments are. Then how to compile a portfolio. See, of investments. Now, when you start building a portfolio, you have to know that you can't keep all your investments in one pocket. You have to keep different types of investment. You have to diversify your portfolio in different areas. Because if you want to lower your risk, you have to invest in portfolio diversification. It entails distributing your assets among a number of assets classes. Your money is better protected from market swings with this strategy. Means you can't keep your funds in one pocket. You have to diversify, one having lower rate of interest, one lower risk, one is having higher risk, one is having medium risk, or you can say where one is having higher returns, lower returns, where if so that a portfolio is not does not give you unexpected returns. Protecting your financial future. Once you started making a diversified portfolio, you have to start planning for your financial future. Like for future, because future is again risk and uncertain. To save, and this helps to your safeguard your financial future. So this is what again you have to know all this. I hope now I should stop here, and we'll continue this lecture afterwards. I hope you liked it. Please share, like, and subscribe. Thank you.